Probal Sen, oil and gas analyst at Centrum, who's joining us this morning. Probal, we've been also talking about RIL and whether or not it's looking like a good buy at the current juncture with the sharp fall on Monday. Is the market, according to you, pricing in a delay or a complete write-off of the Aramco deal?
I think it's probably the latter, particularly at these price levels. I would imagine that the market is not only building in earnings weakness from the petchem segment in a significant way, but also either a cancellation or a long-term deferment of the Aramco deal, or the other way to look at it is they might be building in a revaluation of the kind of numbers that were probably presented by the company. The $75 billion EV that was spoken about by the company. The fear is perhaps that given the weakness in the margin environment, there could be a write down of the deal value itself, which obviously is a bit of a negative. So I think a lot of over pessimism perhaps built into the price at this point of time.
Reliance then, Probal, the petchem business, it seems that it's likely to pan out, or rather top out because of the fall in oil prices. The margins as well already under pressure. What in your mind could be the damage, or what is it that you've calculated that we could see in the coming quarterly performance?
Well, I think the current quarter, which is the fourth quarter, in fact, in January and February, one actually saw a marginal improvement in key petrochemical spreads. Not by much, but at least on a QOQ level, they were looking up. Obviously, with what has happened since then, in March, one can probably see further weakness coming through. So one is likely to see a flattish to a marginal decline from the 75 billion odd EBITDA that the segment reported. But I think the bigger issue really is that, going forward into FY21 and 22, I think the concern that seems to be playing out is that the petchem business can structurally see a little bit more of a decline, particularly given that supply remains fairly comfortable and demand estimates are being downgraded across the board consistently. I mean, every month if you see, there are fresh downgrades being made to estimates of both refining as well as petchem demand. So there I think the downstream earnings are likely to remain under pressure. Having said that, I think what is important to know, particularly for refining, is that if this kind of a crude decline actually persists, or even if crude, let's say, comes down, improves to maybe $45 and stays there, my sense is that you could actually see GRMs even improve from here, because the product prices are already reflecting a very, very weak demand environment for some time now. So even if crude has declined by $15, my sense is that product spreads or product prices will not decline proportionately. So you could in fact have both the OMCs as well as Reliance actually report marginally better gross refining margins going forward. But yes, the overwhelming concern right now is probably on petchem, which is a fairly large segment and which is where a huge amount of capex has been spent by the company. That returns from that segment can be a little bit tepid. So our estimates already factor in about 7-8% decline annualized over the next couple of years. But I guess the bear case scenario probably is building in even 10-15% decline. So from about 376 billion EBITDA in FY19, I suspect the bear case is building in just about maybe anywhere between 28 to 30,000 crore over the next couple of years, which is quite a steep decline. Our base case estimates are slightly above that at this point of time.
On the export business, mainly diesel and jet fuel demand for RIL in this slow environment?
No, as I said, I think demand anyway stays fairly tepid, in the next couple of years. I think based on every estimate that we are seeing, given that the second largest, oil consuming country, China, is still recovering or just about starting to recover from the corona impact. So demand there, at least for the next 12 months, doesn't look like it's going to be, anything to write home about. And even in the US, the full impact of whatever is happening with the coronavirus is still to be felt, and therefore it's very difficult to sort of take a call on when demand growth, if at all, can actually come back. So if you look at industry estimates, this Jan to March quarter is likely to be the first one in the last 11-12 years where oil demand actually is shown to be negative, and some estimates are indicating that even for the entire CY20, demand can actually potentially show a decline in absolute terms, which is not something that we have seen in the last decade or so. So if those kinds of numbers pan out, yes, I think demand continues to remain weak. But as I said, demand product spreads already at just about $10 for diesel and just about $8 for gasoline are already reflecting that kind of weakness. So it's difficult for us to see a significant decline in product spreads from here, unless the coronavirus really starts to impact Western developed countries even more than it already has.
All right, now the other, talking point within this space is BPCL. We've seen the EOIs come in, and do you think that we are likely to see good demand? What about the valuations? How are you looking at all of this in light of the crude price crash?
Well, I think, as far as the profitability prospects for the OMCs are concerned, as I mentioned, we really do believe that with this kind of a sharp oil price decline, the positive impact on crude cost is likely to be, more than the corresponding negative impact on product margins. So therefore, on refining margins, on balance, there could be about $1.5 increment in GRMs for the OMCs, and more importantly, with this kind of a reduction in product prices and crude, one can probably see a further expansion in marketing margins. Our sense is that against the 3.3 to 3.4 rupees a litre marketing margins made in FY19, one can probably make a case for even 4 rupees plus kind of a margin going through over FY21 and FY22, which is obviously significantly higher than what we have seen. So from that aspect, I guess the profitability prospects do look better. As for the appetite for BPCL in this market, I think it really is a function of which players are still looking to invest money, given the kind of stress everybody in the downstream and upstream is facing right now globally. So I really don't have too much insight in terms of who can actually come through. But at this price, I think it probably looks much more attractive than it was at 500 odd levels. So the returns that an investor can hope to make at 420 odd is obviously much better. So one would hope that at this prices, much more global investors could be looking at, tying up a big downstream marketing opportunity like BPCL.
Hope so. Fingers crossed. Well, great to have you on the show and analyze the dynamics of falling crude prices and what it really means for some of the Indian players.
Thank you.